Welcome to panel 5, which is about specialized credit manager in an interval fund, strategies not available in a listed CEF. As I'm sure most of you are aware, interval funds are a type of SEC-registered closed-end fund that expand investor access to illiquid investment strategies through low investment minimums, frequent valuations, and 1099 tax forms. They have become the breakaway star of the alts universe due to their ability to diversify portfolios and solve some of the structural and regulatory limitations associated with private funds while offering the potential to generate higher total returns. We have some knowledgeable speakers on panel 5 today who will help us look deeper into interval fund strategies and structures. They are Kevin Dockrell, Institutional Portfolio Manager at RBC Blue Bay, and Larry Holzenthaler, Managing Director, Portfolio Manager, and Senior Alternative Strategist at First Eagle Investments. Kevin and Larry, please introduce yourself further and tell us about your firms and describe each of your respective strategies at a high level.
Sure, I can go first. Can you hear me okay? I never know how close or how far away to sit from these mics, but you can hear me good? Excellent. Thanks for the intro. So Kevin Dockrell, I head up the institutional portfolio management team at RBC Global Asset Management, the asset manager subsidiary of the Royal Bank of Canada. Within RBC, I represent the Blue Bay fixed income team, and Blue Bay is the active credit specialist manager headquartered in London, and it's Blue Bay, the Blue Bay team that manages the Blue Bay Destra international event-driven credit fund, which will be the focus of much of my comments here. So maybe just a couple of numbers. So RBC globally manages about 500 billion in AUM, of which the Blue Bay investment team manages about 135 across all areas of fixed income, IG, high yield, securitized, EM, kind of you name it. But the team responsible for this interval fund is our special situations team, based out of London, manages about 500 million. So the fund itself, as I said, international event-driven credit. It's incepted back in 2018, has about 300 million. Ticker is CEDIX for those interested. As the name suggests, it focuses across the whole spectrum of stressed, distressed, special situations type of investments. So stressed, looking at intrinsically cheap bank debt or bonds. Typically trading about 60 to 90 cents on the dollar, but in decent companies where we expect a power recovery. Distressed on the other end of the spectrum, where we expect a full-on restructuring, both financial and operational, kind of rolling our sleeves up, getting onto steercos, bondholder committees, and ultimately taking out equity on the other side. And then special situations, ad hoc, event-driven catalyst trades, be it M&A or equity infusions, change of control, etc. So that's kind of the bulk of what we do. It's global in nature. We don't have any sort of regional bias, although we do focus a lot more on Europe, sector agnostic as well. No real macro input. It's more of a bottom-up driven strategy. So that's basically it.
So my name is Larry Hosenthaler. I'm a portfolio manager for First Eagle Alternative Credit. As the name would suggest, we're part of First Eagle Investments, which for anyone familiar with First Eagle is probably most familiar with our global equity strategies. But over the last few years, First Eagle's tried to kind of diversify away from the kind of value equity business. So my team was acquired by First Eagle about 4 years ago. We used to sit at THL, Thomas H. Lee, the private equity firm. So we joined, the team I work on joined about 5 years ago. We also have another affiliate within kind of the First Eagle umbrella, Napier Park, which focuses on kind of credit hedge funds, CLOs, kind of securitized. And then most recently, I'll mention, again, separate team, but First Eagle brought over John Miller, who runs municipal bonds for us. Just about 6 or 7 months ago, John's already raised $4 or $5 billion or so he's been pretty successful. So at this point, First Eagle runs about 130 billion of assets. About 50 billion of that is within what we define as alternative credit. The rest of it is within kind of John's strategies as well as kind of a global value. And so at FEAC, as we call it, we run an interval fund. The ticker is FECRX. Again, we launched about 4 years ago. We also have another 40 Act structure that we'll be launching later this year that is going to be in more of a business development company format. And so really kind of what I would say about our team is we kind of operate in what we think is a little bit unique spot in the interval fund space, in the sense that the way that our team thinks about credit, specifically corporate lending, corporate loans, is we tend to view kind of the corporate loan market as kind of one big universe. And I can make loans to companies in a direct lending origination type arrangement where it's a bilateral agreement between our team and a company. We might make them a $30 or $40 million loan, up through our liquid credit group, where we might own the loan of a multi-billion-dollar kind of syndicated issuer, and really everything in between. But our sweet spot is really liquid credit and direct lending. And so where we kind of sit in a little bit of a unique position is within the interval fund space. I think on one extreme, you find funds that pretty much everything they own is in these illiquid direct lending type of assets. We could talk about this in more detail, but my personal opinion is what's driving the vast majority of money into direct lending is the lack of mark to market. There's other benefits as well, but I think that NAV stability is what optically is driving a lot of dollars in. So you have funds that try to keep a lot of their assets in illiquid assets to keep that NAV stable. And then on the other extreme, you have the funds that are more, I would say, kind of multi-strategy, where they might have liquid credit, direct lending, high yield, CLOs, ABS, MBS. And for us, we're kind of in the middle. We have liquid credit, we have direct lending, but that's it. Everything we do is basically making first lien senior secured loans to companies. So we'll talk a little bit about the interval fund wrapper, but I think really the way I think about it is it's kind of an entry-level step for folks who are looking at the direct lending market, have experience with the syndicated market, to obviously invest in something that looks and feels a little bit more like a mutual fund wrapper within the interval fund space.
Well, let's talk a little bit more about that wrapper. Why do you both believe your respective strategies are befitting of the interval fund structure?
So it's really interesting. For my entire career, I've worked across everything from limited partnership vehicles to open-end daily liquidity mutual funds. And even if we're talking about syndicated loans, which compliance doesn't like you to refer to it, but liquid loans, because they can be liquid, they can be illiquid, but syndicated loans have a secondary trading market. So if I look at BKLN or a closed-end fund, they're typically going to be more involved in the syndicated part of the market. And even those quote-unquote liquid loans, liquidity can vary, and liquidity sometimes can ebb and flow at the wrong time. You can have open-end mutual funds that all get hit with outflows at the same time, and you have a lot of price action that's driven by this dynamic of these daily liquidity mutual funds, operating in kind of an over-the-counter, less liquid market. And more recently, you've had private credit. It's the hot dot asset class, clearly. What I would argue is that private credit at its kind of heart and soul is really nothing new. You're making first lien, senior secured, hopefully loans to companies. It's really just more the structure and origination process that is kind of new. But even within the liquid market, an open-end mutual fund is not the best home for syndicated loans. And on the flip side, you have closed-end funds, which I personally love closed-end funds. I own a lot of them in my personal account. They can be very, very inefficient at different points in time. But the really unique feature about loans is they're very stable. They don't move around a lot. So if I stick a lot of these stable loans in a closed-end fund where the price can swing around a lot, that's not an ideal home either. So an interval fund is really it's not perfect, but it's a great option in the sense that we can kind of control the flows, we can invest in illiquid assets. But I would argue that even in an interval fund format, you want to have some liquidity built in. Most of these interval funds have been lucky. They've seen nothing but inflows on the credit side for the last 4 or 5 years. At some point, that's not going to be the case anymore. So I think investors need to understand underneath the wrapper, what type of liquidity does the manager have if they have 4 or 5 quarters in a row of outflows and the inflows stop. So the interval fund is a great wrapper, but it's still important to understand that unlike a BDC, that 5% tender process has to be managed inside with some liquidity.
Yeah, sorry. I think from our perspective, on the the Blue Bay platform, we manage across the entire spectrum of daily liquidity mutual funds, monthly liquidity hedge funds, quarterly private funds, all the way out to 5-year lockup on the private side. So we're pretty agnostic. And I must say the Destra fund that we manage is the only interval fund that we manage, and there's definitely lots to be said for it. I think in particular for the event-driven fund that I mentioned, there's probably two things that I would point to. First is just the nature of the liquidity of the underlying investments. Now that's it's relevant to an extent, but probably not the overarching view as to why we think it's a good wrapper. If I look at the liquidity of our underlying investments across stress, distress, special sits, maybe about 40% of those could be liquidated within a day. Rough numbers here, about 30% in a week, another 20 in a month, and only really that kind of tail of 10 to 15% of names that would take more than a month to liquidate. So that's one point, but probably the main thing from our perspective as to why we think the interval fund makes sense for our event-driven strategy is just the time horizon for the trades that we're putting on. We do think, if I think about, at one end of the spectrum, at the shortest investment horizon for some of our trades will be 3 months. But if we're going into a full-on restructuring that might take 2-3 years plus to play out, we wouldn't want to necessarily go through all the work, create a committee, deploy the capital, only to be forced to look to exit before the value has been realized. And so really, I think that kind of investment time horizon that we have lends itself well to the interval structure.
Let's take a step back and talk about the market and talk about recent events. So could you both give us a market outlook and describe where you're seeing interesting opportunities from your different areas of focus?
Yeah, sure. I can kick off. It's definitely an interesting time. It's although one big source of uncertainty has been removed over the course of the last week, insofar as we now know who the next president of the US will be. But still, from our standpoint, there's still lots of other sources of uncertainty that need to play out. Just to name a few, what will a Trump 2.0 presidency look like? What will the path for inflation be here in the US and overseas? What the different central bank reaction functions will be the world over as well, and how that will differ. Geopolitics clearly is another source of uncertainty with the war in Russia, Ukraine ongoing, Middle East as well, and clearly China, another source of uncertainty. So it just feels like there's still a lot of macro cross currents out there as we look into 2025. But at the same time, it feels like markets, at least on the kind of the liquid public market side, are priced for perfection. See the S&P hitting new heights every day, it seems. On the credit market side, it seems that spreads at multi-year tights. So it feels like there's a bit of complacency out there, at least in the kind of the more mainstream traditional markets. So you look at things like IG corporate spreads at 75 basis points, or even high yield spreads at 260. It's really hard to make a very strong, compelling argument from a valuations perspective as to why they're a really good place to be, at least from my seat. Not to say that you still couldn't get away with kind of mid-single digits returns in your fixed income portfolio over the course of next year, but for clients, investors who want to get to that high single digits into the teens, it probably should be looking into alternative credit. And in terms of where we're seeing the most opportunities, it really is not in the US. It's more in Europe, where we do think if you have that stressed or distressed lens, that there could be lots of really good opportunities to come.
Yeah, and a few things I'd mention. From a high level, I would say that the kind of the absolute value of credit spreads right now, I would agree, are fairly tight, whether I'm looking at the direct lending market or the syndicated market, or kind of some areas that are kind of in between, I would argue. But I would still say the relative value of credit, to your point, the last year or so, the S&P is up almost 50%, about 25% this year. High yield is getting a lot of inflows, the high yield corporate bond asset class, and spreads in high yield are basically 300, maybe even a little bit inside of that, depending on what index you look at, which is very unusual. If I go back to the mid-1980s for high yield spreads to be flirting with kind of inside of 300 basis point type levels. Now, People would tell you that the high yield market is better quality than it has been historically. That's a fair point. But I would still say that just take a step back, valuations are not super compelling versus if I look at syndicated loans, they're probably 450 over. Again, that's probably a lower credit quality, so not a no-brainer, but potentially a little bit more value within credit and equities. We are not rate people, we're credit people, but what I would say is we talk to, we have 55 people on our investment team. We have about 40 analysts. And so we talk to a lot of companies on a monthly, quarterly basis. And I always like to say we're credit people, so we tend to be somewhat cynical and kind of look at the glass kind of half empty. And I would say that the economy is doing pretty well right now. Coming through earnings season, we're seeing a lot more beats than misses. GDP is still in the mid-twos. So to us, that still feels inconsistent with a 3% Fed funds rate. We think it's likely to remain higher than that based on what we see. So if I take a 3.5%, 4% Fed funds rate or SOFR rate, which our loans typically key off of, I add a spread of, let's say, 450, 500. Even net of credit losses, you're still looking at kind of an equity-like return with obviously less risk. And I'm not talking about volatility, I'm talking about actual risk. I mean, you're senior secured first lien. So where we've been trying to kind of find value within the credit market, one thing I would mention is the direct lending market has grown so much that you now have direct lending deals that are literally multi-billion-dollar deals between a single or a couple lenders and an issuer or private equity sponsor. And then you still have the traditional direct lending market where you're looking at companies that might be doing 20 or 30 million of EBITDA, that might be looking for a $30 or $50 million loan. We refer to that as the lower middle market. And there again, is there no competition? No, there's competition everywhere, but there's less. And the reason that there's less is you have a lot more companies doing 25 million of EBITDA than doing $1 billion of EBITDA. And you have fewer direct lending managers fighting over these deals. I always like to remind people, if you're a direct lending manager and you make let's say $1 billion loan to a company, that loan's going to be outstanding for probably 3 or 4 years. So if I'm getting 1% management fee, it's probably higher than that. I can generate 40 or $50 million of revenue for doing 3 weeks of work. So what are managers going to focus on? They're going to focus on trying to do those $1 billion deals because obviously the economics are a tenth the attractive for a $100 million deal. And it takes just as long to underwrite a $100 million loan as a $1 billion loan. So that's one area, kind of lower middle market. If you look at a lot of BDCs today, you look at the top 10 holdings, these are multi-billion dollar issuers. Most of them were broadly syndicated loans that sat in BKLN a year ago that have refinanced into the private market. The last place I'll mention that you'll probably hear a lot in the press about, because right now everyone is, it's the greatest thing ever. The truth is probably in the middle, is asset-based lending. So not asset-backed lending, but asset-based, where I come in and I make a loan to a company, but the collateral for that loan is not cash flows. It's maybe something like inventory or accounts receivable or a patent, intellectual property. So the assets can vary. You're hearing a lot of articles. Of course, the first articles that come out are, this is the greatest thing ever because you're going to get bigger spreads. Not a lot of people are doing it. It's lending. So I would argue it's just another arrow that you guys kind of have in the quiver to generate attractive returns with hopefully excess return per unit of risk. So ABL is an area where it's pretty specialized. That's a little bit newer, that we're still finding some interesting transactions.
Maybe just to chime in, I definitely agree with your point on the US. It definitely, consensus is that US has managed to navigate this soft landing, but maybe just to contrast it, the picture in Europe is a lot bleaker. You look at somewhere like Germany, which has historically been the kind of manufacturing powerhouse of Europe, and some of the issues that it's having, even most recently with the government collapsing. It just seems that a lot of countries over in Europe are either in recession or on the brink of recession. And a lot of the companies that we're looking at now are really just showing signs of stress. Rewinding back, I think with the benefit of hindsight, a lot of companies were just borrowed a hell of a lot back in the glory days of QE, were then hit with the pandemic, and a lot of them had to shutter their doors and still pay staff, pay rents. So emerged from the pandemic with a lot more leverage and less profitable. were then hit with supply chain issues, hyperinflation on energy prices, and a pretty seismic rate cycle. So now we're just looking, kind of staring down the barrel of a lot of companies who are just far too levered, and need to get their ship in order when, at a time when bank lending standards are tightening and other elements of the capital markets are turning their back. So we see not as many opportunities in the US, absolutely, but certainly in Europe, we feel it's a pretty fertile opportunity set from a stressed investor standpoint.
Did you want to add to that, Larry? Keep it going, or I got another question for you if you know.
Yeah, no, I'll definitely just reiterate that. That so far, we're all U.S. based, as you would guess, especially in that lower middle market, where we definitely do expect a bit of a more firm backdrop where we operate versus obviously overseas. You clearly have a little bit of a different economic dynamic happening for sure.
All right, some good insights. So I'm sure you both would agree that good fund management is important, but you both talked about teams that you work with. Could you give us a flavor for how some of your teams help you navigate future events and due diligence and special situations and so forth?
Yeah, sure. So I think when you're looking at the segment of the market that we are, companies, very highly levered companies that are going through varying forms of, stress or distress, clearly you need to have a very experienced team, individuals who have been through a number of default cycles and kind of just have that deep kind of credit expertise. That's absolutely part of the case. Also, I think by virtue of the fact that we're a large investment platform, that is a subsidiary of the Royal Bank of Canada, just having that pretty large sourcing network and kind of just that being kind of plugged into various segments of the market is pretty important. So in terms of sourcing opportunities, that's very important. But then clearly just being able to do your homework and identifying the right investments and pricing that risk, it's of paramount importance.
Yeah, and so I was lucky. I started my career, 20 years ago in the credit market. My mentor we always used to tease him that he had been in the loan market since before there was even a loan index, which is the Credit Suisse Leveraged Loan Index, which started in 1992. So if you've been in the loan market earlier than 1992, you've literally been in the market longer than there really was even an asset class. And, with credit especially, experience matters. Your risk in credit is asymmetric to the downside. You make a loan at par. If everything goes well, you get your par back. And so, avoiding not getting your par back is how you outperform in the loan market. It's less about finding the next Elon Musk and more about avoiding losers. And so, if you look at, so I joined First Eagle, and again, I can tease our CIO, Jim Fellows, because Jim also has been, in the credit market since, before there was an index. And, why I think that's particularly important now is the credit landscape is really changing. You're seeing the word, creativity used much more frequently than you typically would. I always like to say, take it back to the analogy of if you tried to get a mortgage on a house and you tried to replicate that term sheet with the mortgage company, would they make you the loan? So like as an example, we're now seeing a lot of BDCs that have loans that day one are what they call PIK, paid in kind, which means I'm not paying you in cash, I'm paying you more in the loan you already own. Now, PIK used to be historically associated with stressed companies. So the thinking was, if the company has problems, I will allow you to pay your interest in kind. It's to give flexibility to the issuer. But what we're seeing today are companies that are doing what I call PIK as plan A, meaning your first interest payment is going to be paid in kind. So imagine if you went to the mortgage company and you said, I want to buy a house. I want to put 30 or 40% down on the house. It's in a good neighborhood. We appraise the house. But here's the thing. I'm not going to be able to make my first 5 interest payments. The bank would never make you that mortgage. I don't care if you put 90% down. They're going to walk away from the loan. It's just that kind of flies in the face of lending. And what we're seeing now are things like life sciences, bio. Now, there's nothing wrong with that. There's a lot of very smart people doing that. So I'm not sounding a fire alarm, but it's very different. If you had asked the typical credit investor 10 years ago that 10 years from now, people are going to be willingly buying into transactions that are picking day one, they would have said, no. But so I think, look, it's good that you're able to do more creative things. But our team is a pretty traditional, back to basics kind of corporate lending mentality. And I think a reason for that is our team has been together a long time and we've made mistakes. And we'll make more in the future. And credit is all about learning from your mistakes, trying to avoid them in the future. And so we definitely take that experience seriously. And we take a bit of a cynical view, quite frankly, on some of the more creative, quote unquote, lending going on within some of these different portfolios.
Did you want to add anything, Kevin, before we turn it over to the audience?
No, I think that's very comprehensive, yeah.
Okay, good. Well, this is a good time for Q&A. Does anyone have a question right there?
Just wanted to hear more about Larry. You mentioned, two different buckets that you're playing. Syndicated, sponsor-driven loans where, you may do at a lower yield than a loan up your sleeve, sole capital provider, senior secured person, where you can use a little less leverage. But a syndicated loan, you can apply a little bit more leverage, a slightly lower absolute return, but a slightly lower relative return. Question is, with tailwinds on both of them, sponsor-driven loan, we talked about M&A activity, lower regulation, versus advantages with small caps, smaller companies. Where do you think, I'm not going to say just 1 year, but maybe over the next 2-3 years, where do you feel are the best risk-adjusted returns between those two strategies?
So we're a little bit biased, but what I would say is in the lower middle market, where these guys are not going to have access to the syndicated market, they're smaller issuers, so you're going to get a little bit of excess spread. There's going to be less competition. There's more of them. I think you're able to drive credit terms, 3 turns of leverage or less, loan to value of less than 50%, and still get a pretty decent spread, 550, 575 maybe. And I think in the syndicated market has kind of gotten a bad rap because of the volatility associated with it. But what I would say is that volatility comes with liquidity. It's nice to know I can pick up the phone and call JP Morgan and say, I want to sell this, what's the level? And I can transact at that level or not, but it's nice to have the option. And so I think a lot of people are kind of discounting that volatility as risk. It's actually, that excess vol might actually mean it has less risk because it's liquid. Where I think, again, and we're biased, where I think there's some area for concern is that middle ground, this upper middle market, where you may not have covenants. Everything we do has covenants. It has to. I mean, we are going to go in and make a $100 million loan to a company. We're the only lender and we don't have covenants. That's unacceptable. So we have to have covenants. So if you have an illiquid loan that doesn't have covenants, that's suboptimal. And the spreads associated with this refinancing of broadly syndicated loans into the upper middle market, the really cool thing about that is I can see the transaction. So like Equinox Gyms, which is right down the street here, they're all over Manhattan, used to live in the broadly syndicated loan market. I know the company inside and out because we used to own it. They couldn't refinance their loan a year ago, so they had to go to the private market. So now I can see what kind of spread is the private market getting on that Equinox loan. It's the same loan. It just now lives in a BDC, basically. And I would say that anecdotally, the spread on that loan for the risk they're taking, and now it's illiquid, it's not a no-brainer to me. So I think the upper middle market is an area where there's so much competition and there's so few billion-dollar transactions to fight over, where the risk, the return per unit of risk is questionable. I think in the lower middle market and the kind of core middle market, there's still some value. And again, I think the syndicated market is overlooked. I think everyone loves private credit right now and hates the syndicated market. That doesn't make a lot of sense. They're both making loans to companies. So that's kind of our view.
Anyone else? How about right back there?
So, yeah, this question for Larry. So, you brought up APL, right, asset-based lending. Do you see it from a marketing standpoint? Do you see that asset class sits nicely next to what you guys are doing in direct lending? Like, is there not a lot of crossover there? And just go from your marketing to institution to retail, could you see that very nicely?
They do complement each other pretty well. I mean, one thing about asset-based lending, if you think about it, it's somewhat counter-cyclical. Like as an example, retailers might look to get a loan on inventory when times are tough, and no one's ever going to make them a cash flow loan at that point. So it's kind of another lever that you can pull. You're also going to get, I would say that over time, the spread attached to ABL is generally going to be higher than the spread attached to cash flow loans because they're riskier. I grew up as a credit analyst, and I was a shipping analyst. And you have a lot of hard assets associated with the collateral of shipping companies. And it makes it a lot harder to value because how do I know what the value of that ship is? It's easier to value cash flow coming off of a hotel or something. So as a result of that, you're always going to have extra spread attached to ABL, which when spreads are tight, I can get kind of excess return per unit of risk. But again, sourcing those loans is trickier, so it's hard to build, we think, at this point, an entire fund around ABL, certainly to be multi-billion dollars. But within a portfolio of cash flow loans, it's just an interesting kind of lever you can pull or area that you can look at to generate new originations.
Thank you.
Thank you.
Appreciate it. Yeah.
Thanks, everybody.